Something is happening in the silver market right now, and almost nobody is paying attention to it. While Wall Street was busy dumping paper silver contracts last week, while CNBC was running headlines about silver crashing, while retail traders were panic selling at the bottom, someone was buying. Buying aggressively, buying every single ounce they could get their hands on. China. I'm going to give you the numbers, and I want you to sit with them for a second. In just 2 months, Comex silver inventory has dropped from 240 million ounces in 2020 down to about 77 million ounces today. That's a 64% decline. In January alone, 33.45 million ounces of silver were physically withdrawn from Comex vaults in a single week. 26% of the entire deliverable pool, gone in 7 days. Right now, the May silver contract has 26,963 contracts still open. That represents 134.8 million ounces of potential delivery demand, sitting against 77 million ounces of registered inventory. For every 100 ounces of paper claims, Comex has just 13 ounces of real metal in the vault. Coverage ratio of 13.4%. Anything below 15% is officially what analysts call stress territory. We've been below 15% for 6 consecutive weekly reports. It has not improved once. And first notice day for the May contract is in 3 business days. Today is Sunday, April 26th, 2026. Silver closed Friday at 75.69. Gold closed at 4,188. The gold to silver ratio is sitting at 63-1. China's silver imports just hit record highs. The Strait of Hormuz is closed. Iran peace talks just collapsed yesterday. Brent crude is above $105. The Fed meets in 3 days. In the next 22 minutes, I'm going to walk you through exactly why the Comex system is mathematically pinned. The 3 buyers draining Western vaults in real time, what this week's perfect storm of catalysts means for silver. The historical playbook for what happens when paper and physical decouple this hard. And what to actually watch on Tuesday morning when first notice day hits. This is not financial advice. Silver is volatile. It just dropped 38% from $121 to $75 in 90 days. It can do that again. Talk to a qualified advisor. Position carefully. Let's get into it. Quick foundation, because you can't understand the squeeze without understanding the system. Comex is the New York exchange where silver futures are traded. A futures contract is essentially a promise. If you buy a May silver contract, you've bought a paper claim that says you can take delivery of 5,000 ounces of physical silver in May. In a normal market, almost nobody actually takes delivery. Historically, 97 to 99% of contracts either get rolled forward to a future month or settled in cash. The system works because the metal isn't really the point. The contracts are mostly used for hedging and speculation. That assumption only works when nobody actually demands the metal. Here's where it gets uncomfortable. Comex registered inventory is the silver that's actually deliverable. Sitting in approved vaults, available right now to settle physical delivery requests. As of last week, that number stood at 76.88 million ounces. Total open interest, the paper claims outstanding, sits at roughly 575 million ounces. That's a 7.5-1 leverage ratio. For every ounce of real silver in the vault, there are 7.5 ounces of paper claims floating around the system. Normal leverage in Comex historically runs 5 to 8-1. So we're actually inside the normal range right now. The system has always been leveraged. That's the design. But here's what changed. In January 2026, the delivery rate on Comex contracts spiked toward 5 to 10%, up from the historical 1 to 3%. That's a multifold increase in physical demand inside a leveraged paper system. When more than 10 to 15% of contract holders demand actual delivery, the math stops working. There simply isn't enough metal in the vault to cover the claims. That's where we are right now. The May contract has 26,963 contracts open, 134.8 million ounces of potential demand, against 77 million ounces of registered inventory. If even 60% of that open interest stands for delivery, Comex runs out. That has never happened before in the history of the exchange. First notice day, the day on which contract holders start declaring whether they want physical delivery or cash settlement, is just 3 business days away. Now let me show you who's behind this. Because once you understand the buyers, you understand why the squeeze isn't stopping. Buyer 1, Chinese industrial users. China consumes roughly 20% of the world's annual silver supply for solar panel production alone. They make most of the world's electric vehicles. They dominate global electronics manufacturing. All 3 of those industries are silver intensive. Chinese industrial buyers are doing something unusual. They're pre-purchasing silver supplies 12 to 18 months in advance, taking physical delivery, storing it. This is not normal industrial behavior. Normal industrial users buy as needed. When they start hoarding metal, it means they expect future supply to be unavailable, or future prices to be much higher, probably both. Buyer 2, Chinese retail savers. When gold ran above $4,500 an ounce, ordinary Chinese savers got priced out. In China, owning physical metal isn't a niche investor habit. It's a mainstream way of saving money, the same way Americans use savings bonds or 401k contributions. When gold became too expensive, those savers didn't stop saving. They switched assets. They started buying silver bars instead. In Shenzhen's Shuibei market, China's main retail bullion district, sales of silver bars from 20 grams to 1 kilogram exploded. The result? China imported a record 836 tons of silver in March 2026 alone. That's 173% above the 10-year seasonal average for the month. Year to date, imports have hit roughly 1,726 tons, the highest on record for any comparable period in Chinese Customs Authority history. Buyer 3, institutional investors moving from paper to physical. This is the structural shift that matters most. Hedge funds, family offices, and sophisticated investors are quietly demanding physical delivery on Comex contracts instead of cash settlement. They're moving out of silver ETFs and into allocated vaulted physical silver. Why? Because they understand something most retail investors don't. A silver ETF is a paper claim that tracks the silver price. In a true squeeze where physical supply runs short, paper and physical can decouple sharply. The ETF can fall while physical premiums explode. In January, this exact thing started happening. 33.45 million ounces left Comex vaults in 7 days. Some of those withdrawals came from major institutional players who decided they'd rather hold the actual metal than the paper claim. That single shift from I trust the paper to I want the metal is what tips a leveraged system from functional to broken. Combined, these three buyer groups are creating sustained physical demand that the system was never designed to handle. Now I need to address the obvious question. If all of this is true, if China is hoarding, if Comex is stress, if institutional money is demanding physical, why did silver crash from $121 in January to $75 today? 3 reasons. Reason 1, the CME hiked margin requirements. When silver was running toward $121 in late January, the exchange operating Comex did exactly what exchanges always do when a market starts breaking against the shorts. They raised the cost to hold leveraged silver positions. Leveraged longs got margin called, forced to sell. The selling cascaded into more selling. Classic squeeze, unwind. The CME effectively pulled the brakes on the move that was about to break the system. This wasn't a market correction. It was a managed deceleration. Reason 2, the dollar got strong. The DXY dollar index sits near a 1-week high around 98. A firm dollar makes silver more expensive in every other currency, which compresses international demand at the futures level. The dollar is strong because Iran-related oil pressure keeps inflation expectations elevated, which keeps the Fed from cutting, which supports the dollar. That entire chain hangs on one event, the Iran situation. When that resolves, the chain reverses. Reason 3, profit-taking after a 147% rally. Silver ran up 147% in 2025. After a move like that, profit-taking alone can produce a 20 to 30% correction without anything actually changing about the underlying story. So here's what really happened. The paper market got slammed by margin hikes, dollar strength, and forced liquidation. The physical market kept tightening. The gap between the two widened. Right now, paper silver and physical silver are telling you completely different stories. The paper price says silver is worth $75. The Shanghai premium says silver is worth $80 or more. The Comex delivery queue says paper claims dramatically exceed deliverable supply. China's import behavior says future supply is going to be unavailable. 3 out of 4 signals are screaming higher. One signal, the paper price, says lower. History is extremely clear on which signal wins when they diverge this hard. Now, let me walk you through this week's calendar because it's loaded. Tuesday, April 28th. First notice day for May silver. This is the day that defines the next 30 days for silver. Contract holders declare whether they want physical delivery or cash settlement. If anything close to historical norms holds, Comex delivers normally. If demand spikes the way it did in January, the system gets tested. Tuesday and Wednesday, April 28th and 29, FOMC meeting. Powell's last meeting as Fed chair. CME FedWatch shows 99% probability of no change at 350 to 3.75%. The decision is priced in, the language is not. If Powell distinguishes between energy-driven inflation and demand-driven inflation in the press conference at 2:30 p.m. Wednesday, that's dovish for silver. If he uses the phrase data-dependent in a forward-looking context about easing, that's a soft green light. If he pushes back against rate cut expectations entirely, that's hawkish and pressures silver short-term. Bank of America's economists have been arguing markets are underpricing how dovish Powell could turn at his exit meeting. Morgan Stanley expects the Fed to cut as soon as Kevin Warsh takes over. Wednesday afternoon, mega cap tech earnings. Microsoft, Alphabet, Meta, and Amazon All report Q1 earnings the same day Powell speaks. Markets will be digesting Fed language and $4 trillion tech reports simultaneously. Volatility across all asset classes, including silver, is going to be high. Thursday, April 30th, GDP, PCE, and Employment Cost Index all hit before the bell. Q4 2025 GDP came in at just 0.5% on final revision, way down from the 1.4% advance estimate. If Q1 prints similarly weak, that's a major signal. Combined with whatever Powell said the day before, this single Thursday morning could move silver more than any week in months. Core PCE is the Fed's preferred inflation measure. A hot print keeps the Fed hawkish. A cool print accelerates rate cut expectations. Geopolitical wildcard, Iran. Trump canceled Iran peace talks yesterday. Iran's foreign minister is meeting Putin Monday. The Strait of Hormuz is essentially closed. Brent crude is above $105. Pentagon estimates 6 months to clear Iranian sea mines. Lindsey Graham just publicly suggested U.S. military engagement in the strait may be required. Any further escalation this week amplifies the safe haven case for silver and gold. Any de-escalation weakens it. So you have first noticed day on Comex, the FOMC meeting, megacap earnings, GDP, PCE, and an active Middle East war crisis, all hitting in 5 trading days. This is genuinely one of the most catalyst-loaded weeks for silver since the squeeze in January. The institutional commentary on silver right now matters because we're hearing language from credentialed sources that we haven't heard in years. Bank of America has published a price scenario for silver going as high as $135 to $309. Their bull case. Not a guarantee, but a serious bank putting their name on a $300 number changes the conversation. Citigroup has set their target at $150 to $170, more conservative, still implying a doubling from current levels. The Silver Institute, working with London consultancy Metals Focus, just confirmed the world will consume about 67 million ounces more silver than it mines in 2026. That's the 6th consecutive year of structural deficit. The cumulative 5-year deficit now sits above 800 million ounces. That's an entire year of global silver mine output, drawn down, gone. Reuters analyst poll for 2026 just got revised. The consensus average price target jumped from $50 to nearly $80. The high-end analysts are calling for over $180. Alasdair Macleod, one of the most respected voices in precious metals, has publicly stated his view that silver is going parabolic. His specific take is that the combination of structural deficit, Western inventory drain, and Chinese strategic accumulation makes a $300 print possible in 2026. Now Macleod has been bullish on metals for years, and has been wrong in the short term plenty of times. But his structural analysis has consistently held up. Mining sector commentary is also turning. Major silver mining executives have been describing the market as structurally constrained. Their language is unusually direct for an industry that traditionally talks in carefully hedged terms. What's striking is the consistency. Different sources, different methodologies, same conclusion. The supply-demand balance is broken. Above-ground inventories are getting drained. New mine supply isn't coming before 2033, and the price doesn't reflect any of it yet. Here are the 3 concrete scenarios I'm watching for the next 30 days. Scenario 1, the breakout. What happens? Tuesday's first notice day delivery demand prints high. Powell goes mildly dovish on Wednesday. Iran stays tense or escalates. Silver breaks above $80, then $82. A weekly close above $85 confirms the correction from $120 is over. Next target, $92 to $95. This is the scenario where the squeeze restarts. If Comex inventory drops below 70 million ounces in the next 30 days, paper physical decoupling accelerates. Silver could revisit 100-plussers before summer. Scenario 2, sideways consolidation. What happens? Powell stays carefully neutral. Iran neither escalates nor resolves. May delivery demand prints normal. Silver bounces between $72 and $82 for 4 to 6 weeks. This is the most likely outcome statistically. Frustrating for impatient holders. Doesn't change the structural story. Sets up a stronger move later when one catalyst finally breaks the consolidation. Scenario 3, the breakdown. What happens? Powell sounds hawkish. Iran de-escalates unexpectedly. Megacap earnings disappoint and risk-off becomes broad-based across all assets. Silver tests $72 to $74. A weekly close below $72 is a warning. Below $70 means full reassessment of the near-term thesis. What I want you to notice, none of these scenarios changes what China is doing with silver imports. None of them restarts new silver mine production. None of them closes the supply deficit. None of them rebuilds Comex inventory. All 3 are about the paper market reacting to short-term catalysts. The physical reality underneath keeps pointing the same direction, regardless. Let me give you 3 quick framings depending on where you sit right now. If you bought silver in the 40s or 50s during 2025, you're in significant profit even at $75. Your psychological challenge is the fear of giving back gains. Watching $121 fall to $75 creates a nagging voice asking if you should have sold at the top. What the data tells you. The structural story isn't over. It's in a pause being held down by specific macro headwinds tied to specific events with specific endpoints. Selling here is a bet those headwinds are permanent. The data doesn't support that bet. If you bought between $80 and $121, you're showing a paper loss. Your psychological challenge is the temptation to convert an uncertain paper loss into a certain real one just to stop the discomfort. What to remember, silver moved from $31 to $121 in 12 months last year. If the structural forces that drove that move are still intact, the question isn't whether the price recovers. It's whether you have the patience to be there when it does. If you're considering adding at $75, your challenge is doubt. After a 38% drawdown, buying more feels like ignoring evidence the market just handed you. The framework. Silver has tested support twice in the $67 to $74 zone. Double bottom. In a structurally tight market with this many confirmation signals, that's typically a base, not a breakdown. But sizing matters more than timing. Silver moves 3x gold's percentage in either direction. Whatever you put in, size it so you can hold through another 20% drawdown without panic. One more thing about ownership format. If you're holding silver through ETFs, understand what you actually own. An ETF is a paper claim. Under normal conditions, the price tracks closely and you can sell at market. In a squeeze where physical supply runs short, paper and physical can decouple. The ETF can fall while physical premiums spike. If you own silver as squeeze protection, the form of ownership matters as much as the position size. I won't close without naming the real risks. Anyone giving you only the bull case is selling you something. Risk 1. The China import surge was partly timing. The April 1st solar tax rebate deadline pulled industrial demand forward. April and May import numbers will likely come down sharply. Headlines will say Chinese silver demand collapses. It's actually just timing, but it'll feel bearish. Risk 2, prolonged stalemate. Iran could stay frozen for months. Oil stays elevated. Inflation stays sticky. Fed stays on hold. Silver grinds sideways between $72 and $83 for 6 months. Tests patience hard. Risk 3, hard landing. If holding rates this long tips the global economy into recession, industrial silver demand falls faster than investment demand rises. Roughly 60% of total silver demand is industrial. Silver could revisit $60 to $65 before monetary easing stabilizes it. Risk 4, narrative reversal. If crypto, AI stocks, or another asset class absorbs the capital that would otherwise flow to silver, the investment thesis gets delayed, possibly by years. Hold these risks alongside the bull case. That's what real analysis looks like. Here's where we are. Comex has 77 million ounces of registered silver against 575 million ounces of paper claims. Coverage ratio at 13.4%, below stress threshold for 6 straight weeks. First notice day in 3 business days. The May contract alone has 134.8 million ounces of potential delivery demand. China imported a record 836 tons of silver in March, 173% above seasonal average. Year-to-date imports the highest on record. 6 straight years of structural deficit. 800 million ounces of cumulative drawdown. No major new mine supply before 2033. Iran peace talks just collapsed. Oil above $105. Strait of Hormuz closed. FOMC meeting in 3 days. Q1, GDP, core PCE, and 4 mega-cap earnings all this week. Silver sits at $75.69. Gold at $4,188. Bank of America has a bull case to $309. Citigroup target $150 to $170. Reuters consensus revised to nearly $80 for 2026 average. The loudest narrative right now is that silver had its move and the story is over. The data doesn't support that narrative. The data suggests we're in a consolidation period that frustrates impatient holders and rewards people who understand what's actually building underneath. I want to hear from you. What are you watching first thing Tuesday morning when first notice day hits? Drop your prediction for May's silver delivery numbers in the comments. And what's your year-end silver target? If this breakdown helped you understand the squeeze setup that almost nobody on financial media is talking about, stay disciplined. Stay skeptical of anyone promising you easy money. And I'll see you in the next one.